International equities outpaced U.S. equities in 2025, reversing the U.S. market's long-standing dominance. The S&P 500 returned nearly 18%, whereas developed international markets gained 32%, and emerging markets posted 34%. And it looks like this trend will continue to 2026 and beyond. Investors are taking note and have increased their exposure to global markets. I'm a markets and investing reporter for CNBC, and I've been following trends in both domestic and global markets. In this video, I break down the key reasons many investors are looking beyond the U.S. market. Even though the U.S. market remains the world's largest, investors are increasingly looking to global markets to diversify their portfolios as fiscal and geopolitical risks rise in the U.S.
I have been having a lot of conversations with investors that are trying to understand how to diversify their concentration out of U.S. markets, particularly U.S. private markets as well. And we've been seeing trends in that direction.
There's also the concentration risk. Exposure to the U.S. also means outsized exposure to AI, with the Magnificent Seven companies alone accounting for roughly 1/3 of the market cap-weighted S&P 500.
I am short the U.S. and I'm long, global markets. The U.S. is struggling a little bit with the fact that we've gone from these very competitive large companies or asset light to now asset heavy. And people aren't sure what the returns on capital are going to be in the future. You see sectors and companies every day, significant adjustments because people are afraid of what the future holds. So that uncertainty, I think, is going to play more on the U.S. than it is globally.
Investors are also fearful that Sell America might gather steam, especially as the Trump administration continues to run up fiscal deficits, exacerbate relations with trading partners, and cast doubt on the Federal Reserve's independence.
Sell America is weaker dollar, it's weaker U.S. stocks, it's higher U.S. interest rates, and it's stronger international currencies and stocks. And we saw a pretty significant period of Sell America last year around the time the Liberation Day tariffs were announced. And since then, it hasn't had serious legs. And is there fear that that's going to continue to unravel? Not really that I see necessarily. I think, again, it's probably at the margin caused people to start to look elsewhere for other ideas.
There's also the continued weakening of the U.S. dollar. In 2025, it fell more than 9% and is expected to weaken further. This trend could be motivating investors to buy more international stocks. For example, when the dollar declines, overseas profits are worth more once converted into U.S. dollars, and that boosts returns.
Last year was a great year for emerging markets because of the weakness in the dollar and because of lower interest rates here. And they think that's going to continue into 2026.
The weaker dollar, the bearish dollar trade, I think is here to stay. And I think that is because we're at a very pro-cyclical phase in the cycle. When we look at growth trends in the rest of the world, a Fed that is on hold in our view. So I think weaker dollar, upside risks that we are still seeing on the growth forecasts around the world, not just in the U.S.
With global markets continuing to outpace the U.S. this year, and some forecasts calling for years of international outperformance, investors are watching closely to see what it could mean next for U.S. stocks.
I don't see anything taking down the U.S. public markets and the liquidity and the depth of U.S. markets overnight, but I do think many global investors are thinking about how to diversify their concentration out of the U.S. and where and how to make really long-term bets in other markets that maybe are not dollar denominated as well.